Imagine two people making money in completely different ways. One buys stocks and watches numbers on a screen. The other buys a house and lives inside their investment. Now, here's the strange part. The stock investor usually earns higher returns, yet homeowners often end up much richer. That sounds confusing, right? Let's break it down together. Most people think the secret to wealth is picking the best investment. They argue about stocks versus real estate like it is a competition. But here's the twist. The real answer has less to do with what you buy and more to do with how you behave over time. That is the part many people ignore completely. Let's start with something simple. Over a long period, stocks have grown faster than houses. If you invest money in a broad stock market fund and leave it alone, it tends to grow steadily. Real estate, on the other hand, grows slower when you look only at price increases. That difference is very important to understand. Now think about this. If you invest $100,000 in stocks and leave it for decades, it can multiply many times over. But if you put that same amount into a house, the price increase alone usually grows much slower. So why do homeowners still end up wealthier in many cases? That's the real question. The answer starts with something powerful but risky. It's called borrowing money to invest. When people buy a house, they rarely pay the full price. They use a small amount of their own money and borrow the rest from a bank. This changes everything about how returns actually work in real life. Imagine you buy a house worth $500,000, but you only put down $100,000. That means you control a big asset with a small amount of your own cash. Now, if the house increases in value, the gain is based on the full price, not just your small contribution. That creates huge impact. Let's make it even clearer. If that house increases by just 3%, the total gain might be $15,000. But remember, you only invested $100,000 of your own money, so your actual return feels much bigger. Suddenly, a small increase in price looks like a very strong return. But here's the part most people miss. That same system can also work against you. If the value of the house drops, your losses are also multiplied. Because you borrowed money, even a small drop can wipe out a big part of your original investment. This is where things become dangerous. Now, think about a market crash. When stock prices fall, your investment goes down, but you still have control. You can sell anytime, you can move your money. But with a house, it's different. Selling takes time, costs money, and depends on finding a buyer. You're not as flexible. Here's something interesting to consider. During past financial crashes, stock markets dropped sharply but recovered faster. Housing markets often fell less at first, but recovery took much longer. Some people had to wait many years just to break even. That kind of delay can affect major life decisions. Now, imagine owning a house during a bad market. You still owe the bank every month. Even if the value drops, your payments continue. This creates pressure. You can't easily walk away without consequences. In some cases, people feel stuck because selling would mean losing money or paying extra just to exit. But let's flip the story again. When things go well, owning a house can feel amazing. You build equity slowly with each payment. Over time, you own more of the property. It feels like forced savings. Even if you're not disciplined, the system pushes you to keep investing month after month. And here's a key point. Many people struggle to save money consistently, but when they have a mortgage, they pay it every month without thinking twice. That habit builds wealth quietly. Years pass, and suddenly they own a valuable asset without realizing how much they have actually saved over time. Now, compare that to stocks. With stocks, nothing forces you to invest. You need discipline. You must decide to invest regularly, even when markets are scary. And that's where many people fail. They panic during downturns, sell their investments, and miss the recovery that comes later. Think about this carefully. The stock market itself isn't the problem. The real issue is human behavior. People buy when things feel safe and sell when they feel afraid. That pattern destroys long-term returns. Even though stocks perform well over time, many investors never experience those full gains. Real estate protects you from that mistake in a strange way. It's hard to sell quickly. There are costs, paperwork, and emotional attachment. All these barriers prevent impulsive decisions. So even if the market goes down, most people hold on. That patience often works in their favor over many years. But here's another layer people forget. Owning a house comes with many hidden costs. There are taxes, insurance, repairs, and maintenance. These expenses never stop. Even after the mortgage is paid, you still spend money to keep the property in good condition. That reduces your actual profit. Imagine your roof starts leaking or your air conditioner breaks. Suddenly, you need thousands of dollars for repairs. These costs are not optional. They come unexpectedly and can disrupt your finances. Over time, these expenses add up and reduce the true return you earn from owning property. Now, compare that to investing in stocks. The costs are usually very low. Some funds charge tiny fees, almost nothing compared to property expenses. There's no maintenance, no repair bills, and no unexpected emergencies. This simplicity makes stocks easier to manage, especially for beginners. But here's where things get interesting again. Even with higher costs, homeowners often feel richer because they see the value of their house increase. It's visible, it feels real. Meanwhile, stock investments are just numbers on a screen, which can go up and down quickly and create emotional stress. Let's talk about perception. People remember buying a house for a certain price and selling it for a higher amount. That feels like a big win, but they often forget all the money spent along the way. The repairs, taxes, and interest payments are easy to ignore when looking at the final number. This creates a powerful illusion. Many homeowners believe they earned high returns, but when you calculate everything, the real profit is much smaller. Sometimes it barely keeps up with inflation. But because the process feels rewarding, people continue to believe real estate is always the better investment. Now, here's a question for you. What matters more, the actual return or the behavior that helps you stay consistent? Because in reality, consistency is what builds wealth. The best investment means nothing if you can't stick with it through difficult times. That is the hidden truth behind everything. Let's explore another angle. Some people use real estate not just for living, but for renting out. In theory, rental income can create cash flow. But in many places today, the numbers don't work as easily as before. High property prices and lower rent returns make profits harder to achieve. Imagine buying a rental property expecting monthly income, but instead you end up covering extra costs from your pocket. That situation is more common than people admit. It requires careful calculation and patience. Without it, real estate investing can become stressful instead of profitable. Now, think about long-term wealth. Studies show that many millionaires built their wealth slowly through consistent investing. They didn't rely on quick wins or perfect timing. Instead, they focused on regular contributions and allowed their investments to grow over decades without interruption. Here's something surprising. Many wealthy individuals do not rely on just one type of investment. They combine different strategies. They may own a home while also investing in stocks. This balanced approach reduces risk and allows them to benefit from both systems over time. Let's imagine two friends, starting at the same point. One invests in stocks consistently. The other buys a home and focuses on paying it off. After many years, both have built wealth, but in different ways. One has liquid investments, while the other has a valuable property and stability. Now, here is the key difference. The stock investor must stay disciplined through market ups and downs. The homeowner benefits from a structured system that forces regular payments. Both paths can work, but only if the person sticks with the plan over a long period of time. But there is a third scenario that happens more often than people admit. Someone starts investing, then stops. They panic during a downturn, switch strategies, and repeat this cycle multiple times. This constant change destroys progress. Instead of building wealth, they remain stuck or grow very slowly. So, what is the real lesson here? It's not about choosing the perfect investment. It's about choosing a strategy you can follow consistently, because over time, consistency beats perfection. Small actions repeated for years create results that look impossible at the beginning. Let's bring it closer to your life. If you know you might panic during market drops, real estate might protect you. If you prefer flexibility and low maintenance, stocks might suit you better. The right choice depends on your personality, not just the numbers. Think about your habits. Do you save regularly or do you spend easily? Do you stay calm during uncertainty, or do you react quickly? These questions matter more than the investment itself, because your behavior will determine whether your plan succeeds or fails over time. Now, here's something powerful. You do not have to choose only one path. You can combine both. Own a modest home and invest in stocks at the same time. This approach allows you to build stability while also benefiting from long-term market growth. The key is balance. Avoid overcommitting to one asset while ignoring the other. By spreading your efforts, you reduce risk and increase your chances of success. This strategy may not feel exciting, but it works quietly in the background for many years. Let's talk about patience. Wealth building is not fast. It takes decades, not months. People who succeed understand this and stay committed even when progress feels slow. They trust the process and allow time to do its work. Here's a simple truth. The longer you stay invested, the more powerful compounding becomes. Small gains build on each other and create larger results over time. This effect is strongest when you avoid interruptions and keep your money growing continuously. Now imagine stopping that process again and again. Every time you sell or switch strategies, you reset your progress. This is why consistency matters so much. It allows compounding to work fully without disruption. Let's bring it all together. Stocks offer higher growth potential. Real estate offers structure and stability. Both have strengths and weaknesses. The best choice depends on how you manage your behavior over time. Here is the most important idea. The investment itself is only part of the equation. Your actions, decisions, and discipline matter as much, if not more. Without the right behavior, even the best investment cannot help you build wealth. So instead of asking which is better, ask yourself this: which one can I stick with for the next 20 or 30 years? That question will give you a much more honest answer. Because in the end, wealth is not built by making perfect choices. It's built by staying consistent, avoiding mistakes, and allowing time to do its work. That's the real secret most people overlook. And here's something worth remembering. The richest version of you is not the one who picked the best investment. It's the one who stayed committed long enough to see the results. So take a moment and think carefully. What kind of investor are you? The answer to that question will guide your path more than any market trend or financial advice ever could. If you understand this, you're already ahead of most people because you're focusing on the one factor that truly matters: your behavior over time. Keep learning, stay consistent, and choose a strategy that fits your life. That's how real wealth is built, step by step, year after year. And remember, there is no perfect path, only the path you can follow consistently. Make your choice wisely, and more importantly, stick with it. That's how you win in the long run. Not by speed, but by staying in the game. And that's the difference between those who dream and those who actually build wealth over time.